Welcome everybody to this short video within our strategy series. We're looking at Bollinger Band reversals today and give you a little bit of guidance on what the strategy looks like and of course things to consider in terms of your trading plan. Let's start by just talking a little bit about what Bollinger Bands are all about. They were developed in the 1980s by John Bollinger and have become a popular indicator since, used regularly for a variety of purposes in terms of price action. Their primary function is to demonstrate volatility, looking at how that relates to price moves and highs and lows of the market. And they consist of three lines. The middle line is a 20-period simple moving average. And then we have an upper band and a lower band, which is set as a default at 2 standard deviations from this simple moving average. You don't need to worry about the maths, of course, because it's all there on a chart worked out for you. So let's look at a chart with an example. And you can see on this Euro Aussie daily chart, we have the middle 20 SMA and those two bands outside. In times of low volatility, those bands will come together. In high volatility, you'll see the bands moving apart. There's 2 or 3 ways you can trade this, but we're going to focus on a reversal when we get a significant price action in one direction, as we see here. So when we're looking at a reversal, we're looking first of all for a price closing outside of one of the bands. That significant price momentum will ultimately potentially run out of steam as the buyers disappear and we get a period of exhaustion and possibly a pullback to its more usual state within the bands. That movement back inside the bands may offer a potential reversal opportunity. The beauty of this is that whatever you're looking at, whichever time frame or asset class you like to trade, you'll see this happen regularly. It's classed as a mean reversion strategy as it is returning to that normal state, as I said before. So here's a couple of diagrams in more detail about what it might look like. If we look at the bullish band reversal, what we get is a downtrend with that close outside the lower band, and then of course move back inside with a bullish candle closing within its top third, often with associated high volume. This, of course, has moved back up to that 20 simple moving average as you see here. Conversely, of course, if it's a bearish move, then we see initially an uptrend, close outside the band, close outside the upper band, and then a move back inside the bands, and away we go again to the downside. Let's have a look at some real chart examples just to clarify this for you further. We'll look at the gold chart on an hourly. You can see there's the close beneath the band. In fact, we had 2 closes, 3 closes outside the band. We often see this walk down the band, so it's really important to be patient until you've got confirmation that we're back inside the bands, and there you can see moves back through the 20 EMA and almost in fact up to the upper band. We can see another example down here. There's the close outside the band, bullish reversal back inside the band, and then we have this move up ultimately to the upper band. We had that pullback there. So there's a few ways you can play the exit with this, which we'll talk about in a moment. If we look at the alternative, the bearish version of this, we're going to use the euro yen as an example on the 30-minute chart. You can see even in times in relative low volatility, we've got that move outside, the move inside with a bearish candle closing near its bottom, and then that move to the downside again. We ultimately hit the lower band. Once again, on the second example, a move outside the band, move back inside, and again, we're going to move to the downside to the middle 20 moving average. And again, ultimately, we found ourselves back down here. So some important extras to consider, which I've sort of referenced indirectly there. We should be looking for confluence factors as well as the price movement, such as market structure. If we get a bounce off a support level, which corresponds to this move outside and then inside the bands, that may add weight to the move in your desired direction. Look for potential agreement on higher time frames if you're trading short time frames, such as 15 or 30 minutes. And of course, staying away from data release may all be worth exploring. Volume, again, is a key feature that you may want to have a look at. Because we've got clear landmarks, Stop placement is usually placed beyond that candle outside the band. So if it's a bearish reversal, we'll place it above that candle that finished outside. If you move back upwards, then that really means your trading idea hasn't worked this time. As I suggested, some may place the profit target by the middle line, or others may use this for a partial close and let the rest run, or perhaps just simply trail as it moves in your direction. You need to test for you which is the right approach based on your risk tolerance and trading style. Generally speaking, trail stop strategies are encouraged with this, not just simply having a stop and a take profit. So in summary, I hope that's been interesting. You can see Bollinger Band reversals may provide multiple opportunities for trading a mean reversion type of strategy. One of the attractive things about it is it's relatively simple to see it objectively on a chart in terms of a setup, and there's key markers for both stop and take profit levels. So it can be a good strategy to add to your trading toolbox without being too complex. Of course, as with any strategy, testing is key and should focus around identifying those confluence factors that make a move in your desired direction more likely, and of course, mastering exits to risk management. Trade safe and see you again soon. Bye bye for now.